Hello, everyone. Thanks for joining. Our guest today is Keith Weiner, CEO of Monetary Metals. Keith, welcome back.
Hey, Evan, thanks for having me.
Yeah, it's a huge pleasure having you back on. I wanted to get you on to talk about, all the excitement that's happening in the gold and silver space. Right now, a lot of people online have been talking about all the gold inflows that's coming, overseas into the U.S., the new all-time highs as well. What are your thoughts on all of this?
I tweeted, as I sometimes do, to make a serious point, but sometimes in a slightly snarky way. Everybody loves the higher gold price, but the only way to profit from it, other than with monetary metals, is to sell some of your gold.
Right.
So, do you want to do that or not? And actually, the higher the gold price goes, the more it validates the decision, not to. And obviously, if you need it because you have a life event, business opportunity, divorce, marriage, all those things, sure. But other than that, the idea that you're slowly liquidating your capital should be kind of concerning to most people. So to put in a plug for monetary metals, we pay interest on it. Deposit your gold, get 4% on it. So we're paying right now. So have your cake and eat it too. Other than that, the high price is exciting, but at the same time, do you really want to trade your gold for fiat currency?
Right. That's the dilemma.
A lot of people in the world obviously want to go the other way. They want to trade the fiat currency for gold, which is why the price is up.
Yeah. Well, I
Okay.
Well, I've been stacking gold for quite a while now, and now as I see the higher gold prices, I was like, I don't want to trade it for Canadian dollars. Canadian dollars are dying.
I'm just saying the other currencies are even worse than the US dollar.
Right.
Guard. And of course, they were making all-time highs when gold was not an all-time high in the US dollar. Now it's all-time high in the US and obviously all-time high in all the other currencies too.
Right. What are you seeing right now? Because a lot of people have been talking about, a ridiculous amount of the inflows coming into the US from LBMA and everything like that. Like, why do you think this is happening? How is it affecting precious metals market prices? Yeah, like, what are your thoughts?
The first point to make is that, and we've done an article and a video and I think a whole series on how not to analyze gold. And the overarching point is that there's an awful lot of gold out there. Virtually all of the gold mined in, as far as we know, 6,500 years of human existence is still in somebody's hands. Very little of it is lost. It's too valuable to lose. A ship sinks every once in a while, but divers try to recover a lot of that. People are buried with gold teeth, but they're grave robbers that sooner or later will come and recover that. Um, so all that gold is still in somebody's hands. And when that gold, so think of this ocean of gold, right? And when that gold sort of sloshes and goes down here and up here slightly,
Right.
it doesn't really mean anything for the price. There's no meaningful correlation. And so whether it's in London or whether it's in New York doesn't really, it's not a response to price and it's not going to cause the price move. The response to something else, which I'll get to in a minute. There are a lot of, for lack of a better word, theories as to what brings the gold into the US, and some of them are pretty exciting sounding. They're sort of James Bond. U.S. government officials have somehow stolen all the gold or done something clandestine with it, and now that Doge is going to audit, Fort Knox by dragging a video camera through it. By the way, that's not what a real audit looks like. A real audit is months of paperwork, and it's not very exciting at all. It's very boring, and only accountants could really love it.
Right.
Now that Doge is going to audit it, they have to quick, let's get all the gold and buy up the gold in Europe and bring it back. Okay, that's an exciting sounding theory, but we'll just leave that for where it is. Another
Right.
that the U.S. is preparing for a gold standard, and Trump's going to make America strong, and all the gold's going to come back. But a lot of times these things are very prosaic, and I'll use that word a lot because when you understand the gold market, retail investors tend to assume all the other players in the market are similarly situated. Okay, with bigger amounts of capital to spend, but they think, okay, I've got X dollars. I can put those X dollars into Bitcoin. I can put those X dollars into real estate. I can put it into stocks. I'm going to put it into gold or some of it into gold. and I'm betting the price is going to go up. When the price goes up, I'm happy and I sell the investment and I move on. And
Right.
all the players in the market are doing that. And that's why there's been so much confusion about the short position. Who in the world would be short? Well, it's a clandestine, dark cabal, the central bank, and the big bullion banks, or whatever, because if you're short, that means you're betting the price is going to go down. Nobody in their right mind will be doing that unless there's a conspiracy, blah, 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 blah. So they see something like gold flowing from here to there as a price thing, when in fact it's a spread thing. So the big market makers, which tend to be the banks and big trading houses, um, are not, their whole business model is borrow to buy an asset, and the asset produces a return, a yield greater than the cost to borrow.
Right.
If interest revenue is greater than interest expense, you have net interest margins positive. That's how a bank makes money. And so when people talk about Bitcoin as a reserve, they kind of don't understand this. The banks are not in the business to borrow to buy something that has no yield, but maybe its price goes up. If its price goes up, okay, fine. If its price goes down, well, they don't talk about that. And these are generally millennials with a 30 or 40-year time horizon. They don't understand a bank needs to show yield every day. You can't just say, well, at the end of 30 years, it's going to be fine. That's,
Right, right.
so what banks do in the gold market is carry, simultaneously buy spot and sell a futures contract. And, because credit is very cheap for a bank, that can do very large positions of that. And they make a small spread. And that spread is on the order of $10 a month. It's not massive.
No.
So, okay, fine. But now you have the threat of tariffs. And that threat arose the moment that Trump won the election in November. And he's been saying, tariffs for years. It's not like this is a surprise. But when he won, okay, now we have to deal with this. So if you're the risk officer at a bank and you have your traders who put on $500 million position of long physical metal, which is London, very important fact to note here, long physical in London and short futures in New York, you might
Right.
have in New York. If there's a possibility that tariffs are going to be slammed down, that's a 25%, $750 an ounce cost to import the gold. That you have the gold, but now you can't get it into the US without paying that $750 penalty. If you're in this trade for $20 for a 2 month duration, they're going to carry you out in a body bag.
Right.
So they said, okay, well, let's move the gold from London to New York, because once it's in, they don't necessarily care that much whether it's in London or New York. Yeah, there's some advantages to London. There's better liquidity there for physical metal, but bring it to New York and then you mitigate this risk.
Right.
They try to do, and then you run into that there's limits to the bandwidth for the logistics guys. When you go into a big vault and it's famous and it's, all this stuff is said about it, but at the end of the day, it's an underground thing, and you've got, a handful of employees that are required to do an operation. So any physical move would be 2 employees. Accounting for it would be at least 2, and then 2 to look over their shoulder and audit. And then you've got people in the monitor room with looking at all the cameras, controlling, pressing the button. You get to enter the man trap, then you close that door. Then we metal detector you. Then if we like the outcome, we open the other door. You get to go out. Like, it's a highly controlled environment.
Right.
Very labor intensive, because most of the time there's not really a great deal of movement in and out. Suddenly, every bank and every trader is trying to move metal from London to New York. You run into a bandwidth issue there. It doesn't mean the Bank of England has run out of gold. It just means that
Take more time.
John and Joe and Bill downstairs only have so much bandwidth to move bars. Trying to move all the bars, not all the bars, but a lot of bars. They don't. It's not elastic, right? And how much capacity they have. So that's what's been going on. It's response to tariffs, and I sure hope that they don't put. I don't want them to put tariffs on anything, because I don't think it's good, but
Right.
certainly not on gold and silver, which are a financial market. They're not consumer goods. To put a tariff on it, all you're going to do is you're going to destroy the market in New York and force it to move, elsewhere. So I'm sure places like Dubai are, saying, hey, go do that, buddy. Because Dubai is poised. They've got, a futures market. They've got other things going on there. And if it doesn't work in New York anymore, it's going to have to move somewhere else. But
Yeah.
you can't have a financial market with a 25% tax, potential, right? So if the gold is in the US, it won't be taxed. If the gold has to come in to deliver, it's 25% tax. I mean, that kind of uncertainty of that kind of loss is far too great. Markets don't work that way. So just move.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used. Is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use, so that instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
Yeah, so they're just covering their risk, and it's all about the spread.
That's it, covering the
Yeah.
risk.
Yeah, no, that totally makes sense. Now, Keith, I wanted to get you on also to talk about what happened recently with Monetary Metals. You guys had a report out. Can you talk about it? I'll put the link in the description below. But yeah, can you speak a little bit about the report?
I don't want to give away the punchline, which is the price targets for the metals,
Right.
but I will say we're in a bull market. This bull market has different drivers than the one of 2009 to 2011, which at the time made me uneasy, and I wrote a lot about this, that the driver of that market was very simply QE is going to cause massive inflation, if not hyperinflation, therefore buy gold. And the problem is the basic premise was wrong. And so if people are buying for the wrong reason, eventually, you might say, well, we're happy they're buying for any reason, but if they're buying for the wrong reason, eventually they decide to stop buying when they realize the reason is wrong. And then it turns out they sold. And so that was the end of that. This time around, I think the reasons are more varied, much more global. And I think this is a durable bull market. Interestingly, you would have expected a correction by now. I would have.
Yeah.
And at the time I was writing, which was before the report hit, and the report hit last week, I said, we may the correction may have started because it was like a couple down days in a row. And of course, that turned out not to be the case. Here we are at a new record high today. So that's the hazard of writing several days in advance of when you go to print. Is take the, yeah. But we're in a bull market. I think the reasons are better reasons this time around, more durable bull market for a lot of reasons, including that. And it was corrections along the way. Nothing moves in a straight line in markets, but a disparity between gold and silver, right? And the reason is, and people should be more curious in general. I guess that's my little rant for today. People should be asking the question, why is there two monetary metals, gold and silver? Why not just one? Almost
Right.
everything in this world tends to be winner take all. I mean, when you're talking about markets and network effects, it tends to be winner take all. Why isn't it just gold? Why silver also?
Right.
Well, smaller transactions, but that's not really that satisfying an answer. But when you drill into it, you realize there's a different group of people that are served by silver versus gold. Silver has always been the wage earner. If you set aside 10% of your weekly wage, so think of that today. Suppose you're making, I don't know, 500, 600, $700 a week. And you want to put 10% of that, $50, $70 into metal. Silver will give you maybe not a big handful, but sort of a half a handful. Gold will give you a little fleck. You wouldn't put it in your pocket because it would get lost in the lint.
Right.
And more importantly, the bid offer spread on gold gets very wide when you're talking tiny little flecks, like a fraction of a gram. Whereas in silver, so money is the most marketable commodity, marketability being, the spread. The narrower the spread, the more marketable it is, the less loss you take to trade in and out of that commodity.
Right.
Gold is the most marketable, has the tightest spread. But it's very important to say gold is the most marketable for larger size transactions. And really small transactions, silver is actually the most marketable. That's why silver endured. and gold never quote unquote won and swept the field.
Right.
And still true today. Now, the problem is gold trades off against other capital assets. So gold is for the capital asset owning class. Silver is much more the working man. And I've been saying this for a long time, but even certainly since 2008 and the financial crisis, arguably 2001 and that little crisis, labor and wages have been under downward pressure. And so as those folks feel the pressure, they don't have the budget. If they're struggling to put food on the table, they're not necessarily stacking a lot.
Yeah, that makes total sense.
So you don't see silver. Silver is, would have to go up another 50% just to get to its nominal all-time high. And gold is making new all-time highs. It's 50% over the last cycle's all-time high, which was way over the all-time high back in 1980 when silver made its all-time high. So wage earners have been under pressure really since 1971. And you can see that in silver, where its highs are just not as impressive against gold, and each one is a lower high. So I do think the silver price will be moving up. And I said if gold hits, here, silver is going to hit. It's going up. It's not going to be an impressive. Gold could be an impressive looking number.
Right.
That's the silver number, at least my call. It's not that impressive, and it'll be up a bit, but that's the thing of it. So for silver demand today, you have some wage earners that are stacking, and you have some industrial demand. So it's sort of halfway between copper and it's always halfway between copper and gold, and now it's tilting more towards copper.
Yeah, no, that totally makes sense.
Electronics and appliances and antimicrobial, we have all those uses, great. But as the economy slows down, and of course tariffs, that's exactly what a tariff is designed to do. It's a partial embargo that a country imposes on itself. So you're going to get less trade, less goods produced, less goods being sold, less silver going into manufactured goods.
Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep stacking. Yeah, no, that totally makes sense. Keith, I'm going to put the descriptions for Monetary Metals in the link below. I highly recommend everyone please go check out Monetary Metals. I'm also going to put the report that came out last week in the link description below, so that way, it'll actually have the price targets that Keith was talking about. Well, you didn't actually give away the price targets, but it'll be in the report from Monetary Metals. And Keith, where can people connect with you?
So I'm at Real Keith Weiner on Twitter. That's KEI and WEI. There's imposters that capitalize on my fame, such as it is, and adult versions of my name, Keith Weiner 2, and all this stuff at Real Keith Weiner, and you get to see my snarky, but I think pointful tweets.
No, it's a huge pleasure having you down, Keith. As always, I'd love to have you back on in the future as the market develops. But thank you so much for coming to see the whole silver and gold community and speaking to us, because yeah, it's always a breath of fresh air when you come on.
Thanks for having me, Ivan.
Talk to you soon.